The rumour mill in Westminster is spinning fast, and at the centre of it is Chancellor Rachel Reeves. Over recent weeks, speculation has grown that the Treasury is weighing up reforms that could see a new property levy introduced, potentially targeting homes valued at £500,000 or more. Though no official announcement has been made, the possibility alone has set alarm bells ringing among homeowners, investors, and housing market analysts. The debate highlights the delicate balance Reeves must strike between repairing the public finances and protecting households already under significant financial strain. The backdrop to this speculation is the Treasury's urgent need to plug a budgetary hole estimated at anywhere between £20 and £50 billion. The Office for Budget Responsibility has recently downgraded its forecasts for the UK's productive capacity, leaving Reeves with a difficult task: stabilise the public finances without stalling a fragile economy. Reeves has already ruled out rises in income tax, VAT and national insurance, politically sensitive and electorally costly moves. That leaves her looking at other tax bases, and property is one of the largest untapped assets in the UK economy. Property wealth in the UK is vast and highly concentrated. The housing stock's now valued in the trillions, and homeowners in London and the South East in particular sit on enormous paper gains due to the decades of rapid house price appreciation. This makes property an attractive target for policymakers. Unlike income, which can be volatile, property values are seen as stable, and taxes linked to them can deliver predictable revenue streams. Furthermore, the UK's property tax system is widely regarded as outdated. Council tax is still based on 1991 valuations, and stamp duty penalises transactions rather than ownership, creating distortions in the housing market. Economists have long argued for reform. What Reeves appears to be considering, according to reports, is a levy applied to homes above a certain value, possibly starting at £500,000. In theory, this would target wealthier homeowners while leaving the majority untouched. The mooted threshold of £500,000 is politically significant. In many parts of the country, such a levy would only affect high-value properties. But in London and the South East, where average house prices are much higher, a huge proportion of family homes would be drawn into the net. This is one of the reasons the idea is proving controversial. For households in these regions, the family home is often the main asset, purchased with large mortgages and maintained at considerable ongoing expense. For them, being caught by a new levy could feel like punishment for little more than living in an expensive part of the country. Critics argue that using property value as a proxy for wealth can be misleading. A retired couple in London who bought their home decades ago may now own a home worth well over £1 million but live on modest pensions. A tax based on property value rather than income risks hitting such households disproportionately. Some observers believe that these potential tax changes are not firm policy, but rather a way for Reeves and the Treasury to test the waters. By allowing speculation to circulate in the media without directly confirming or denying it, officials can gauge public reaction and the level of political resistance. If backlash proves too intense, the ideas may quietly be shelved. If the reaction's more muted, the ground may be prepared for gradual reform. This kind of trial ballooning is not unusual in policymaking, especially on issues as politically sensitive as taxation. Another strand of speculation concerns capital gains tax, CGT. At present, the main home is exempt from CGT when sold. Some reports suggest Reeves could consider removing or limiting this exemption for high-value homes, perhaps those above £1.5 million. That would be a radical departure from existing policy and would spark significant opposition, especially from those who see the exemption as a core protection for family wealth. However, advocates argue it would bring fairness by aligning the treatment of property with other assets. Shares, for example, are liable to CGT when sold, so why not property? Yet the political risks are high. Scrapping the exemption entirely would likely be viewed as an attack on the middle classes, while applying it only to luxury homes would raise questions about where to draw the line. Speculation about a property levy also overlaps with ongoing debates about reforming council tax and stamp duty. Council tax banners have not been updated since 1991, leading to glaring inequities. A modest semi-detached house in the Midlands can face a similar bill to a multi-million-pound townhouse in central London. Economists across the political spectrum agree that the system is overdue for reform, but politicians have repeatedly shied away from the issue due to its sensitivity. Stamp duty, meanwhile, is widely disliked for discouraging mobility in the housing market. A property levy could, in theory, replace both taxes, creating a simpler, fairer system. Yet, such a change would involve enormous disruption and complex transitional arrangements. It's one thing to critique the current system, it's another to implement a politically palatable alternative. For homeowners, especially in high-value regions, the idea of a new tax is unsettling. Many are already facing higher mortgage payments due to rising interest rates, coupled with increased energy bills and general inflation. The prospect of an annual levy or a hefty CGT bill adds another layer of financial insecurity. Estate agents warn that even the rumour of such reforms could cool housing markets as buyers and sellers pause just to see what happens next. There are also concerns about intergenerational fairness. Younger people struggling to get onto the housing ladder may welcome the idea of taxing property wealth, but for older generations who see their home as both security and legacy, the possibility of new taxes feels a bit like moving the goalposts. Beyond individual homeowners, investors are watching closely. The UK housing market has long been a magnet for domestic and international investment. Uncertainty over the tax regime risks denting that confidence. International investors in particular could see the UK as less attractive if property ownership is seen as a liability. This could in turn have knock-on effects on the wider economy, particularly construction and associated industries. Rachel Reeves faces a delicate balancing act. On one hand, she must demonstrate fiscal responsibility, reassuring markets that the UK is on a sustainable financial path. On the other, she must avoid measures that alienate core voters or damage economic confidence. Property tax reform offers potential revenue, but at high political cost. Reeves's decision-making is complicated further by Labour's electoral coalition, which spans affluent urban professionals and struggling young renters. A policy seen as punishing homeowners could alienate the former, while inaction could frustrate the latter. Other countries provide some guidance. In the US, annual property taxes are the norm, funding local government. These are often much higher than UK council tax bills, but they're accepted as part of the system. France has a wealth tax that includes property, though it's been controversial and subject to reform. Each example shows the political challenges of taxing property. Such measures may be economically rational, but they're rarely popular. It's important to stress that at this stage, all of these ideas remain speculation. The Treasury has not confirmed any specific plans, and leaks or reports may reflect internal discussions rather than settled policy. Reeves has repeatedly emphasised that she's considering all options, but no decisions have been announced. This uncertainty, however, has its own consequences. Homeowners, investors and markets crave clarity. Prolonged speculation risks undermining confidence regardless of what is eventually decided. If Reeves decides that a property levy is politically untenable, she does still have other options. These include inheritance tax reform. Tightening rules on gifts and exemptions could raise significant revenue without touching property ownership directly. Pension tax relief. Reducing reliefs for higher earners could deliver billions, though at the risk of backlash from middle-class professionals. Wealth taxes. Broader wealth taxes have been floated, but are politically controversial and difficult to administer. Corporate taxes. Increasing taxes on business profits is another option, though again this risks deterring investment. Each option comes with trade-offs, and none are without controversy. As the autumn budget approaches, Reeves will be under pressure to show her hand. Markets, voters and party colleagues all want clarity. She's promised not to raise headline taxes on income, VAT or national insurance, narrowing her room for manoeuvre. That leaves her with difficult choices. Rachel Reeves must tread carefully, weighing the need for financial stability against the realities of household finances and voter sentiment. For now, homeowners can only watch and wait. The prospect of a £500,000 property tax raid may remain speculation, but it's speculation with real consequences. Whether Reeves ultimately chooses this path will reveal much about her priorities as Chancellor and about the future direction of the UK economy.